Hello everybody, my name is Drew Demon and I'm the Devil Stockbroker. This is going to be a tutorial video on how to trade the SPY with small capital. I see this complaint a lot, especially within my own Discord, where there's a lot of traders that are new to trading that are working with a really small account. They got a small portfolio, and most of us focus on the market. We're focused on trading just SPY or one of the other main markets like Dow Jones or the NASDAQ, and they're really expensive. Like, you look at the SPY and people think, well, geez, I can't afford to go long on a share of SPY. Like, I have an account that's only like $100. Like, I can't do that. Well, that's fine. You can learn to trade the SPY and use something called leveraged ETF. The SPY itself is an ETF of the SPX, actually. So the concept is very much the same. When you're looking to trade the SPY, what you're actually trading is the S&P 500 stock market. This is the entire United States stock market of the top 500 companies in the U.S. economy. So the SPX, or the S&P 500 index, has been broken up into other ETFs that are broken up into sectors. And the most popular one is the SPY because it's very well balanced. It's pretty heavy in tech, but it has a whole basket of other stocks that are a part of it. If you open up the stock heat map for the S&P 500 index, this is what you'll see. You'll see it's broken up into different sectors: technology services, electronic technology, health technology, finance, retail, energy, producers, all this different stuff. So these baskets of stocks are how we play the stock market. Now, what does that have anything to do with trading something with small capital? Because the SPY is still really, really expensive. Well, there are leveraged ETFs that trade against the SPY or that track the SPY, but they are much, much, much smaller in their price point, and it makes it more accessible to traders with small capital. So if I drop down to the SPY on, we'll just go down to the 15-minute. And today's market, if you want to go back in time and look at this is October the 4th, 2022. And this is our current market. So we've got a few things going on here. We see that we've got the market surged past its 200 period moving average on the 15-minute. If we go to the 1 hour, we see that we're starting to run into some resistance. Now, the market's pretty overextended, and we've been in a bear market for a while. And we just gapped up today. All of a sudden, we filled this previous gap, and now we formed another one. So now we're looking to trade this to the downside to fill this gap over the next week. Now, SPY, if you look at the price of just even the share price, every share that you play is going to cost $375, whether you're going long or short. And if you're playing with a cash account, then you can't go short at all. Like, only margin accounts have access to shorting. So what do? Well, you can go with a leveraged ETF, okay? And I'm going to start with the most popular one, which is UPRO. This is built by ProShares Ultra Pro S&P 500 ETF. UPRO is a leveraged ETF that tracks the S&P 500 specifically against the SPY, and it's leveraged 3 times. So whatever the SPY does, UPRO multiplies that movement, or it's balanced in a way that attempts to multiply that movement 3 times. And if you look over at my watch list over here on the side, you'll see that SPY is currently up 2.39% today. UPRO is up 7.13%. That's an exact 3 times multiple. So you can trade UPRO with a smaller account because it's only $32.83 a share, which still a little bit expensive. There's other ETFs that you can play that might be a little bit cheaper than this, but this is a good start. So if you wanted to trade against the SPY, you can trade UPRO. And keep in mind, there's some advantages and disadvantages to leveraged ETFs. For starters, whenever the SPY goes up, this thing goes up 3 times. The opposite is also true. If SPX goes down 1%, then UPRO goes down 3 times as much. It'll go down 3%. So we can use this to trade the SPY with a small portfolio by going short on the market the same way. So you can actually open up a short position here on UPRO and set a stop loss just above this evening star candle right here. We've got a perfect evening star setup. with a big green candle, an evening star candle, and then a confirmation engulfing red candle right here. This is a perfect short opportunity. So I can set myself up with a nice, we'll go with a 2.5 risk to reward ratio. Now, if I go ahead and open up this limit order, I can go and buy, we'll say 10 units of this, and that would be equal to 10 shares. My total risk would be, because I have a stop loss, I'm trading this with a stop loss, my total risk is $6.60, so that's the most that I can lose if I get stopped out. But my gain, my potential profit, would be $16.70. I'm trading this as a short bet at $32.83, and this will cost me $311.60 in my margin account. So I'll go ahead and execute this, and boom, there we go. Now I have 10 shares of UPRO sold short. I'm risking $6 with my stop loss. And I mean, if I was trading with a small portfolio of like $500, this would eat up about 60% of my margin, but I could do it. I could take this bet, and I can do it affordably. It's a lot of margin to use, but it's still a small enough amount of money that I can actually afford to trade this with 10 shares, and that's a decent amount of leverage. My max risk is $6, but my chance of getting $17 back out of this is really good. So this is a good risk to reward setup. I give myself a good opportunity to be correct, good probability of succeeding in my trade. So let's go ahead and take a look at another way that we could take this very same bet, except we're going to use an inverse leveraged ETF. Okay? So for that, we have another ETF called SPXU. SPXU is also made by ProShares Ultra Pro, except it's a short 3 times leveraged ETF. And SPXU basically does the same thing, except it's doing the opposite of whatever the SPY does. So I'm actually going to put both of these on the same chart. I'm going to put the SPY on the chart as my main chart, and I'm going to take away these moving averages to simplify this a bit. So you can see that the SPY is moving down, right? And overall, on our trend, we're having a rough time in the SPY. I'm going to go ahead and add SPXU to my chart. And I'm going to do new price scale. And let's look at this chart. If we zoom out, look at that. Whatever the SPY is doing, SPXU does the opposite. So I can trade this exact same setup with SPXU. Now, the one thing that I want to do is I want to make sure that I'm trading according to the technicals, and I only want to set my take profit based on a price that kind of lines up with my probability of being correct against the SPY. So what I'm going to do is I'm going to invert the SPXU chart, and this is a little trick I use to kind of figure out pricing so that I know where my take profit is on my inverse ETF. So you can do this on TradingView by right-clicking on the scale for SPXU, go to invert scale, and now the scale has been tipped upside down. And I'll adjust my scale slightly so that the line chart matches up with the candlesticks. And what this has done is it's given me a chart that matches almost perfectly with SPY and SPXU. And why would I do that? Because I want to trade according to the technicals in front of me. So if I'm trading the technicals on SPY, I know that the SPY take profit is down here at $369, we'll say. But if I didn't invert the scale on SPXU, I wouldn't know what that price is. But now, if I go ahead and set my take profit right here with a horizontal line, I can see that $369 on the SPY is roughly about $20.25 on SPXU. And notice, again, this is an inverse ETF, so it's doing the opposite. So by going long or betting on SPXU going up, I'm simultaneously betting that the SPY is going down. And now I've got a take profit here for the SPY and I've got a take profit here on SPXU that matches up with that. So now what I can do is I can go over to SPXU and put that on my chart as my main chart. I'll go ahead and take away the duplicate. So now I know that SPXU, my take profit is going to be up around $20.25. So I'm going to go and take a long bet now. I'm going to set my take profit at $20.25, and I'm going to set my stop loss right below this morning star, because remember, there was an evening star pattern on the SPY. Now it's a morning star on SPXU. See how that works? So I'm going to go ahead and adjust this a little bit. I'll play with the limit order so that things match up. I'm going to do a 1875 for my stop loss. I'm going to lift my take profit to 2025. And now I can trade 10 units of SPXU. And my total risk, according to this, is $4.80. So with a stop loss, this is the most that I can lose. I'm paying 10 units of SPXU. So this is going to use about $192.30 of margin. So you just multiply the price by 10, and that's how much margin you're dedicating to this trade. And now I go ahead and hit buy. And this sets me up with a 2.24 risk to reward ratio. That's a good risk reward ratio. My maximum risk is $4.70. That's the most I can lose on this trade. And my max profit is $10.30. And now I can just step away from the chart, and now I'm done trading for the day. I just let the trades play out. And that's it. And this is what I can do with a really, really small portfolio. And what about with options? You can actually trade options on SPXU and UPRO. So I'm going to really quickly go pull up Webull, and I'm going to show you how this looks on Webull so that you can look at the difference in pricing and options so that you can trade options on this. So here I've got Webull on in front of you, and I'm looking at the options chain for the SPY. So we got the chart down here, and this specific chart is for the SPY puts. So let me switch this over to the main chart. Okay, so here's the SPY again, and you see we have the same chart set up right here. Okay, currently trading at roughly $375.50. And we want to go short on the SPY, okay? So we could do a couple things. If we wanted to go into a put contract and we wanted to go out of the money, well, this put contract is $239, and this is expiring this Friday, which is really close to expiration. And that's a lot of capital to dedicate on a single contract. If this does end up going in the money, it could pay out, but if it doesn't, then I'm going to lose $240 almost with commission. So what's another way that we can take this same bet? We can go with SPXU again. Or you could go and buy a put on UPRO. So let's go check out UPRO first. If we look at UPRO, we can see that UPRO's got the very same setup. Now I can do a put on UPRO, and $32 is the next strike for UPRO. That would put me down to here. So right here before the gap starts is where my UPRO put contract would be in the money. And this only costs me 72 cents. 72 cents per share, or $72 per contract. On the ask side, it's trading for 75 cents per share, or $75 per contract. This is a much more palatable bet. It's way smaller. I can spend $75. I would spend just as much money on a nice expensive dinner. So this is a much easier bet for me to take, and it's within my technicals. Because remember, my take profit for UPRO was down here at the bottom of this gap. So if I wanted to take this trade, it would only cost me about $75 to do it. Let's go take a look at SPXU and see if there's another advantage. Now this is inverse, so it's going the opposite way. We want to go and trade to the upside to fill this gap, right? So the same bet. Now we have a $19.50 strike, which is even closer to where we are. $19.50. This bet would only cost me $53 for a near the money call contract, or I could even go in the money. I could even go in the money by 20 cents. And this would only cost me 75 bucks. This is the same trade. In fact, this is a better trade because it's in the money and it only costs me $75 per contract. This is way more palatable. If you're trading with a small portfolio, you only have a few $100 or maybe $1,000 to risk, you can trade these leveraged ETFs and it gives you a massive advantage. If you're right, you're up big on these trades. And if you're wrong small. It doesn't matter so much. You can trade these way easier. And learning to trade the SPY is one of the first things that every beginner trader needs to learn how to do, because if you can't read a broad market, then there's no way that you will be able to learn how to trade a more complex, nuanced individual stock ticker. You have to learn how to trade the market first and do it consistently. If you can be consistently profitable trading in the market, the broad market, you can do well as a trader. But before you go on to advanced research, learning how to trade fundamentals and going into all the advanced stuff, you need to learn the basics trading around the SPY. And leveraged ETFs is how you can learn how to trade the SPY in a safe safe numbers with small amounts of capital, taking small amounts of risk to take good gains. So take some time. If you didn't understand any of this, please go back, watch the video again. It takes some time to get used to this, but please consider using this as an alternative to trading the SPY, taking huge risks. Learn how to trade the SPY around these leveraged ETFs. There's a way greater advantage to you as a beginner trader trading with very small capital. You only have so much that you're able to risk in this market as you're starting out. This will give you a greater chance, greater probability to be correct on your bets, get more wins on your trades, and not force you to take huge risks on a large ticker that requires you to bet hundreds and hundreds of dollars at a time per bet on way out of the money contracts. Perhaps one of the biggest mistakes, and this is a little bit of an aside, but when it comes to trading options, I see a huge mistake that a lot of traders make, and that is because they can't trade these close to the money contracts, they go way out of the money and they'll do something like buy $368 puts right now. And this is way outside of the technicals for the SPY. And yeah, it could happen, but if you force that trade, $368, that's right there at the very end of that gap. That's exactly at your take profit. So if you are correct, you could be up big, but the chances that you take profit at exactly the right time, at exactly the right price, is so much lower. You decrease your probability of a win by going that far out of the money. Ideally, you want to stay close to the money or in the money so that there is delta value, there's intrinsic value in your options contract that gives you time to get out. One of the disadvantages of the ETFs, though, I need to go over this with everybody because there are disadvantages to using these. For one, these ETFs have something called drift. Drift is a condition that's unique to ETFs because they have to constantly be rebalanced. And rebalancing causes a slight amount of loss every time it happens. These ETFs rebalance daily. You notice how like the SPY rebalances every few months when they add something new to it, and the S&P adds new tickers to the SPY and takes old tickers off. That creates rebalancing, and that creates a net loss for traders because that rebalancing has a cost associated with it. UPRO, SPXU, these rebalance every single day. So that will create over time a net loss, and it creates a drag on the portfolio. And if you go back to the weekly chart, you'll notice that going back from the bottom of the COVID crash, this ticker has gone from $11 to $80, which is great, but it's still nowhere near the amount of gain that the S&P had gotten overall, this ticker would have actually performed less well over the long term than just betting on a leap option on the SPY or just buying shares of the SPY outright. So that's something to consider and be aware of, that if you want to bet long on UPRO, you want to do it for short term. And this condition is even more extreme in SPXU. SPXU is even more severe. If you go back in time for SPXU, if you were betting short on the SPY for all of this time, you obviously would have been way wrong. But every single time that there is a daily rebalance in SPXU, there is a drag on the SPY, and it's so extreme that you can even see it on the daily chart. Like, even though the SPY has been going down since March and May, this thing is basically consolidating the whole time, this entire bear market. So you have to take very short-term bets on this, no more than a few months away, and you want to capture these big swings, these huge moves that happen over the course of a month, rather than trying to bet 3 months in advance and taking a net loss because the move didn't happen quickly enough. So that's something to be very, very, very cognizant of as you go and start experimenting with these ETFs, is that this is for day trading and short-term swing trading, never for long-term investments, and never to bet on a long-term downtrend or long-term uptrend in the market, because chances are it will go the opposite way, and then the rebalancing will create drift and you will see losses in your portfolio. So hopefully this has given you some good insight on how you can trade a smaller amount of capital against the SPY and still make big wins, and learn how to trade the market in a safe and less risky way, trading small amounts of capital for huge swings in both directions. That's all I got for you guys today. Thank you so much for watching, and I'll see you next time. Have a hell of a time in the markets.